Good morning, everyone. My name is Victoria Balogun. Speaking from DataPro Limited, and I want to welcome us all to this year's annual media training by DataPro Limited. And we are so happy to have us all here today. Um, we this training, which holds annually, aims to bridge the gap between credit rating agencies such as ours and the media. This year, we'll be focusing on understanding qualitative factors in credit rating consideration. Would to Going through this session with us is our Chief Rating Officer, who is also our Executive Director of Operations at DataPro Limited, Mr. Dele Adeoye. This session is going to be running it's scheduled to run for 2 hours, but we're hoping to make proper use of our time and have us all back at various our businesses in the shortest time possible. I would like to have a very interactive and enjoyable session, so we're enjoying us all to mute our mics and use the chat box where we have questions. We can write down our questions, and Mr. Daly will be answering questions from there when it's time. Without further ado, I will be handing over to our facilitator, Mr. Dele Adeoye. Thank you all. I wish us all an enjoyable session.
Thank you very much, Victoria. I'd like to also welcome members of the media and team members that are already on the call at this point in time. I guess we're expecting quite a number of people to join, but with profound respect to those of us that joined as early birds, we feel it would be a disservice to hold you on without kickstarting the program. I'm hoping that as the training progresses, others will join us as we get along. So on that note, I'd like to welcome every one of us. Please feel free to ask your question. Towards the end of the presentation, I may leave some time to take questions from us. And if there are important questions that you think should be addressed almost immediately, please make use of the chat icon on your system or on your device. I'll be going there intermittently to see questions that are there, and I will be responding to them as the case may be. So once again, thank you very much. The essence of our conversation today is understanding qualitative factors in rating consideration. But before I delve into that, I'd like to note that this is not our first engagement. We've had some in the past. It is just one of our avenue to, as a rating agency operating in Nigeria, over the past 30 years, to also give back to the society in terms of education in line with the mandate of the Security and Exchange Commission that capital market operators should also engage members of the public so that we can widen the level of knowledge about the operations within the capital market. In response to that, DataPro has three-pronged approach. One of them is this. The second is our October annual international webinar. And the third is our rating brief, a newsletter that we normally issue to the public for those who are on our mailing lists. And for the purpose of this engagement, we will be seizing the opportunity of our interaction today to also add you to our mailing list so that you can have access to that monthly newsletter. Having said that, let me now go to the meat of the issue, which is understanding qualitative factors in rating consideration. Here, I will be looking at some introductory conversation. I will also be looking at the concepts of credit rating. What exactly is credit rating? And that is very important, as when you look at capital market as a whole, a lot of people are very quick to note or to observe that perhaps the only operator within the capital market space is the stockbroker. And the reason for this is not far-fetched. Stockbroker is an arm of the capital market that have maybe popular handshake with the investing public. The next to that could be the issuing house and the rest of them. But more often than not, people really understand when you say, I work for a rating agency. The appreciation for who is a rating agency, what is rating agency all about, and the rest of them is quite low. So we are going to be speaking to what rating agency is all about in the course of this presentation. We'll be looking at the value propositions of credit rating, the framework, and we'll go into the important role of qualitative factor in arriving at rating opinion. Thereafter, we'll be looking at what should be the role of the media. Well, this is me. And I think from the opening remark provided by my colleague, Victoria Balogun, she has rightly introduced me. My humble self, the Executive Director Operation for DataPro Limited. I also double as the Chief Rating Officer. So I supervise the rating desk for DataPro Limited. I've put in nearly 25 years on the job. And I think with that, without sounding very modest, I am in a very good position to take you through this session today. So why are we into this? Like I said, this is not the first engagement with the media, and this is the third edition. What was running through our mind when we decided to run through this, to take this route? Like I said, we just want to key in into the vision of the Security and Exchange Commission for education and enlightenment of the investing public. And we felt that that could not be properly achieved if we do not talk to those who are at the forefront of driving this education. That's why we are palling the media. Number two, we felt that to correctly disseminate information coming from rating desk, the media itself must have clear understanding of qualitative factors that a rating agency will readily consider in arriving at rating opinion. A lot of people till date believes that rating opinion is a black box. You really do not know what a rating agency is actually thinking about. So you take gladly whatever is the rating opinion without challenging it. So we just want to unpack some of these myths and let us know that almost everyone has a role to play in how a credit rating agency works. We also want to promote the value proposition of credit rating industry. Believe that if you know what it means to get a rating and you know the advantage of getting a rating, you will be able to sit up as a businessman, guide jealously those things that matter in getting you to the appropriate destination of your business. We want to also use this as an opportunity to seek collaboration and cooperation with the media so that some of our views can be heard and from understanding point of view. We want to also expose the public to some unpopular and seemingly significant areas of credit rating where you think it does not play. A lot of people today think that rating is all about weaving ratios together and some high level of quantitative analysis and the rest of them. But we want to draw attention to these qualitative, subjective trends and patterns that may appear insignificant on the surface. However, if you aggregate all of them together, it makes a lot of sense in the final analysis. We want to be able to equip the media with adequate know-how, how to interpret and report rating outcomes. A lot of time, the outcome of our rating will require that we put it in the public domain. And I am sure for those of us coming from the media, the print, the electronic, the online, and the rest of them, you would have seen more often than not rating opinion being communicated via the media, rating actions, a download, a downgrade, upgrade, as the case may be. So this, we want to be able to put it out there that the media understands some language of the rating agency and that the public is not misinformed by the way we put certain things. We also want to instill a credit culture in Nigeria. We believe that if the rating is properly understood, those who are approaching our capital market and money market for fund will be able to do it with a lot of caution, with their reputation intact. And if that pan out well for them, it will rub off on the economy as a whole and ingraining the culture of credit and enhance our credit system. We do not claim to know all, even as a rating agency. The reputation of the ratee are key issues to us. And a lot of time, some of the information surrounding what we do and how we do it could be impacted by the reputation of the ratee. The rating could be fine on the balance sheet, could be fine on the income statement, could be fine on the notes to the account, on the audited account. But there are some juicy details that may not be available to us as at the time of making that decision. So sometimes we might have to also rely on information on public domain to also understand the character behind every credit applications. And this is where the media also play an important role. Some of the outcome of your investigative corporate investigations and the rest of them are a good avenue to help us in that space. And that is the reason why uh, we think it's an important decision to have handshake with a member of the media. We want to underscore, even from the global perspective, that credit will always be um, the way to go. And it appears that the year 2025 is giving us a good narration around the use of credits. And what do I mean? The global outlook suggests that global economy in terms of GDP in the year 2025 we grow at about 3.3%. And this is riding on the fact that generically interest rates are coming down and inflationary pressure is easing. When you combine these two factors, then it can lead to productivity. And when we talk about productivity, to enhance, one of the factors enhancing productivity is availability of fund. And one of the factors that encourage those who are involved in production to also, seek this fund is the favorable term, particularly around interest rates. So when interest rate comes down, it makes access to funding easy, and people will naturally gravitate towards debts. So we saw that credits to both the public and private around the world will be more available as we go on. If you come to local environment, Nigeria environment, you also observe that Nigeria economy is mirroring what is happening at the global space. Well, we can argue back and forth and say, oh, the inflation is coming down as a result of the rebasing. However, we can say categorically that we've had two consecutive decline in inflation. And the CBN has also given, a green light as to the fact that if inflation is constant or trending downward, the likelihood that the monetary policy rates will also respond accordingly. And that was noted in its decision of February 2025 to hold NPR constant. All of these mean one thing. Funding will be available. Credit will be available. People are going to want to access credit, and that will further enhance productivity. But the part of concern is, as people access this credit, there will be a need for rating, because the providers of the fund themselves are sometimes under regulatory and statutory obligation to only give the fund to those who meet certain rating criteria. What those of us that work in the rating end refer to as investment grade rating. So, on account of that, we expect that at both macro and micro level, we are going to be looking at a situation whereby funds will be raised from both the capital market and the money market. In fact, the budgets for 2025 is an indication that even the federal government of Nigeria will also address some of its deficit borrowing based on debt. And as it is going to happen at government level, we also expect that that will also happen in at corporate level. So if it's going to happen at corporate level, it's going to happen at the government level. It therefore means one thing, that one of the lookout for is the fact that there will be a need for credit rating. So what exactly is credit rating? How did we even come about credit rating? Credit rating agency like us, DataPro, emerged in the United States around the 1840s. And the first credit rating agency, the Mercantile Agency, was founded in 1841 by Louis Stephan. So this agency collected and sold information about credit worthiness of business. And so that suggests to you that the basic duty of a rating agency today is to give opinion as to the credit worthiness of any business, to give opinion as to the credit worthiness of any business, to give that opinion as to the capacity of any borrower to repay its debt as and when due. So in the 19th century, other credit rating agencies such as Dun& Bradstreet, which was founded in 1849, out of which Moody came out in 1909, and of course, DataPro in 1995, when we were starting out, had relationship with this Dun& Bradstreet. And I can say that that is a relationship that gave us the inspiration that we can replicate the same feat here in Nigeria. During the early 20th century, the credit rating agency expanded their service to include rating for bonds and securities. So from looking at corporates, they moved on to bonds, they move on to securities, and today this has expanded to now include other rating agencies that we now know, such as Standard & Poor, or which is popularly known as S&P in 1926. Thereafter, we have Fish, which also came out in 1920. And by the 1930, the US government saw a need to begin to regulate the activity of credit rating agency, having understood that quite a lot of people now rely on the opinion. Even though rating opinion is not expected to be a perfect substitute for your own judgment in imparting with your money. However, it has come to the knowledge of government that quite a number of investing public or lending public relies on this opinion to be able to make decisions. So that led to the need to regulate the activity of rating agency. And this is also replicated in Nigeria. So today, credit rating agency is a regulated entity. It's a regulated environment, and the regulation is done by our own Security and Exchange Commission, the Securities and Exchange Commission. So like I said, like every rating agency out there, we started operation in Nigeria in 1995. And based on our relationship with Dun & Bradstreet, we became Dun & Bradstreet Correspondent Office in Nigeria in 1995. And we held that relationship up to 2003. By 2003, we started offering background information to services to US Embassy, Australian Embassy, and the rest of them. we became licensed as a rating agency in Nigeria by the Security and Exchange Commission. We offer consultancy to the investment trust fund of the Nigerian Exchange. We are also a trainer today based on approval by CIBN in line with the competency framework of the Central Bank of Nigeria. We are also a licensed trainer by NICOM. We are a licensed DPC or Data Protection Compliance Organization by NIDA. We've offered several compliance solutions and consultancy between 1995 until date. So the journey has taken us up to 30 years. So, but specifically to our credit rating, we provide rating that cuts across all of what a typical rating agency will do, ranging from corporate rating to bond rating, CP, structured and unstructured papers, and as the rest of them. So let's begin to go to the basics. What exactly is credit rating? Credit rating is an opinion on the credit worthiness of an issuer, such as corporation or government, based on their ability to meet their financial obligations, like repaying debts. It is an assessment of the ability of an issuer, that is, anyone who wants to borrow, in a very simple language, even though in rating language, we refer to them as issuer of instruments. But what technically they are doing is that they want to borrow money. So rating is the opinion about the ability of that borrower to repay the interest that is due on what he has borrowed, to repay the loan or any other debt instruments issued by so. So like I said, in a very simple language, credit rating is opinion about the capacity of a borrower to pay its debts, whether now or in the future. So credit ratings are used by investors who want to know the risk. So when it comes to bond, FGM bonds, corporate bonds, state bond, local government bond, which some people also call municipal bond, it is used by investors who want to know the risk of buying those bonds. Another instrument issued by any of these entities that I have mentioned, be it government or corporate, as the case may be. Now, so from what I have said, credit rating is solely focused on credit worthiness. And that's why it may not be a perfect substitute for your own judgment. When a credit rating agency is looking at an entity, the primary focus is, can he borrow? Does he have that cash flow strength to repay its debts? And is that cash flow protected? Whether governance protected, regulatorily protected, statutorily protected, environmentally protected, and so on. So we'll look at it from those points of view. Why the effect of credit rating may feel like a judgment on a company or a country's character, history, or existence, it is not. It only utilizes those elements to decide on one simple question: what is the likelihood of a creditor receiving their investment back in time and in full? If I lend you 1 billion, will I get my 1 billion as promised by you in 365 days? Will you be able to pay the interest due on this 1 billion in 365 days? So those are the simple questions a credit rating is trying to answer. A credit rating agency offers two distinct products. It can rate the issuer ability to pay. It can also rate the debt itself, the bond itself. Some bonds are structured in a particular manner that it might become so necessary to begin to look at how these bonds are structured, how the bonds are structured. At the same time, you might not necessarily look at the debt itself, but you might look at the owner of the debt by looking at certain information. So an instrument rating where a particular debt instrument like bond is rated, the purpose of the rating is to provide an opinion on the ability of the issuer to meet the terms of that particular security and the terms attached to it. In terms of time horizon, timeline of that opinion, the time of validity for a credit rating opinion is usually 12 months forward or 1 year forward. But in order to arrive at that opinion, it might be necessary for us to have a look back to consider historical performances. Where were you as a company 5 years ago, 4 years ago, 3 years ago, 2 years ago, and a year ago? We'll put all of that together and begin to look at what will likely happen in a year's time. So time is a good factor. And that's why we want to be able to see what were your performances under different economic scenario. For instance, when we're looking at the company today, we are asking ourselves, 2020 was just 5 years ago. How did you fare in that year of COVID? Then 2023 is a year of subsidy is gone. How did you fare under removal of subsidy as a company? Then maybe about 6 months or thereabout later, we enter into an era of unification of exchange rate windows by CBN, and that led to significant devaluation of Naira. So under that scenario, as an operating entity, how did you fare? And so that's the essence of having to look back to see within economic turbulence, economic prosperity, recession, and progressions. How did you fare in all of this? If you survive, how did you survive? If you took a serious hit, what was the level of impact? So that allows us as a rating agency to look back, and then on the basis of all of those scenarios of how you fare, we can bunch things together and thereafter predict what will likely happen in about a year time. So that is the effect of time on rating decision and why it is necessary. But like I said, we are not God. So, and it is almost impossible for anyone at all to accurately predict what will happen in the future. So, rating in itself is opinion of the rating agency. The only difference is that this is opinion that is based on analysis of information available to that rating agency as at the time the opinion is about to be made. This opinion that we talk about can come in different levels, but the investing public and the rating agencies themselves have come to summarize this opinion into two broad levels. The first is the investment grade, and the second group is non-investment grade. Some will look at it and say the non-investment grade is junk rating. What's investment grade? The general belief that once the rating agency attach a rating that is called investment grade to your organization or to a debt instrument that you issued, then it is a comfort zone for investors to, one, invest in you or in the instrument issued by you. Two, it may also mean that you are getting a rate that is lesser, or you are getting funds cheaply or cheaper than those that are at non-investment grade. Why? Because the belief is that once you have investment grade, the risk of repayment, of meeting your obligation is minimized relative to your rating within the investment grade band. Now, for non-investment grade is considered to be a high-risk region within rating opinion. And if that is your rating, a lender, an investor may choose not to invest in you or in your instruments, except, and of course, where such a lender or investor is not risk averse, or such investor is aggressive. But that is going to come to you at a cost, because the interest that will be demanded on your instrument is going to be higher than that of an entity within the investment grade band. And that is how it affects you as the borrower. So on account of this, every organization, entity that are likely going to be assessing the debt markets are always striving towards moving to an environment where they can get investment grade. So when we say investment grade is actually a rating beginning from triple B minus to triple A. So anytime you see an organization being given triple B to triple A, just note that that is an investment grade. So it would be wrong for you to report as member of the media when, for instance, if maybe my title is the title of my press release is just reading uh, uh, DataPro assigned double B to RR Limited. And in your trying to report, you say, you now report it as DataPro has just assigned an investment grade rating of double B. That is misnomer. That is contradiction. Because double B among the lenders and investors and the rating agency is not an investment grade. You can keep your language simple by saying DataPro assigned rating of double B. But if you must use the word investment, then you must be able to add that is a non-investment grade. So because a non-investment grade starts from double B plus down to D, while investment grade begins from triple B minus to triple A. Rating also comes with outlook and watches, meaning that a rating agency has that responsibility to monitor over a period of time that the rating that assigned is valid. Don't forget that I mentioned earlier that a rating has a validity period. Most rating has validity period of 1 year. In other words, 12 months. So within these 12 months, a rating agency is paying attention to operating condition of the company under its rating, under its watch. In fact, when you look at a typical rating report, the rating agency already give an indication as to the level of monitoring that is going to be brought to bear on the rating assigned. That's why sometimes you see rating outlook. It could be stable. That means this company, no matter what happened to this company cannot leave the band of the rating that has been assigned, given all parameters that has been considered. But when the rating outlook is positive, it shows that the rating assigned, given the condition of this company, will likely change or will likely improve in a short while, or as at the time the rating will be renewed. And if the rating is negative, it means there are parameters or conditions around the company that the rating agency is looking at. And if there is any significant change to those parameters, the next rating of this company will actually go down. And this is why I think as media personnel, we should begin to see ourselves as important components of the job function of a rating agency, because part of the lookouts done by a rating agency is the fact that we will also be paying attention to some of the stories you publish around these entities. You might not know. But every time you have a situation, for instance, if we've just rated a company and we have in the public domain, somebody is talking about the fact that, in the last 6 months, this company has not paid us. And then we might pick that. Even though it is gotten from the media, not from the rated entity, we might pick that and ask the company to come and have meeting with us, to begin to discuss with us. I hope you're not paying staff. It's not an indication that you're having liquidity problem. Sometimes we could be in our office and while we are paying attention, we can stumble on the media reporting that a court has just given an injunction against a company and against some banks to put lien on the accounts of those companies. That's information for us. And we will have to call the company and ask, because regulatory compliance is also part of what we look at. So we are asking, what regulatory requirements have you breached to bring you to this point? We need facts of the case. We need to analyze it and come to that conclusion, whether or not that can affect the rating already assigned. So this is how Outlook and Rating Watch play out for us. I think with the few points I've been raising, for us, you would have been seeing now the connection between what we do as a rating agency and the job that you do as media personnel, a lot in the few things that I have said. Okay, we also have sovereign rating. This is another, but when we use the word sovereign, it means that we are looking at government issuing bonds. And sometimes it could be Euro bond, especially when it is Euro bond. It means that the debt is issued in other currency, and investment is expected from people outside our immediate environment. So, for instance, Nigeria is issuing bonds into the international community. They expect people from India, China, investors from India, China, US, and all of that, because the bond is raised in dollars. That's why it is called Eurobond. And those people too will also rely on rating. They want to know what's Nigerian rating and how much Nigeria is offering based on its rating. And because of that, they want to compare Nigeria with other countries that are using similar Eurobond at that point in time. What is their rating and what is the interest they are offering? If the interest does not justify the rating, they might ignore Nigeria issuance. So that is also the importance of rating to sovereign issuance. Okay. So, but the uniqueness of sovereign issuer is that a lot of time, most information that we look out for quantitatively may not be available. You know, because this is government and a lot of things are not taken seriously. So you might not have the document that give you quantitative information about this company. So what does that about government? So what happened? A lot of reliance is placed on qualitative information. Qualitative information. And those qualitative information could be strength of political institutions, the rule of law, history of past defaults, and the rest of them are some of the qualitative information that becomes necessary in determining sovereign. So there are three main expectations of a credit rating agency. There are three main expectations of credit rating agency. Number one is accurate prediction. Even though I said it's only God that knows tomorrow. But a rating agency is making an attempt to look into a period, 1 year or 2 years, or the duration of the lifespan of the issuance. And it's trying to say, okay, I think on the basis of probability, this issuer is likely to pay off its debts as when due. So even though we are not God, but we try as much as possible to ensure that we are near accurate in our opinion. Then it's also timely, because it does not make sense that the opinion is coming after a lot of people are pumping their money. It's better it comes prior to, or the opinion is valid. And that's why validity of rating is key. And that's why it is a good ground for the media, for members of the public in general, to challenge an entity that has an offering, that has a debt running, but its rating has expired. Expiration of rating is a public information. Almost all rating agencies publish that. When you check the DataPro website today, if you are looking for any company of interest, you can check and you can see whether that rating has expired or not. And if a rating is expired and you have not come back for a renewal, it's a valid ground to challenge that company, because for you not to go back to renew your rating, then there must be something you are running away from. Except, of course, if you already have done rating with another rating agency, and the only reason that you are not doing with rating agency A is purely commercial. That is fine. But that you do not renew your rating and you do not have any rating running, after which you have collected money from the public and you do not feel there is any need for you, the media can challenge that. Even the regulator too is doing well in that regards. They will ask some of them, go and get your rating has expired, can we have another one? I know FMDQ is doing that, I know SEC is doing that, but the media can also do that. Stable prediction to maintain consistency, and that is why rating outlook and rating watch is key. What are the benefits of rating? Rating help to conduct credit research in order to can aid credit research. If you are looking into speaking to credit worthiness of an entity, maybe a quick spot to look at may be the rating of this entity. Number two, it also a rating surveillance. Oh, you've had a pension money is put into a company and the company now had issue and the rating has fallen below investment grade. Is a valid point to raise. It puts the company on its toe that whatever you are doing right now that enable you to earn that rating, you should continue to do it. You can't say, oh yeah, I already got what I wanted. I already have money to build my factory. I already got money to buy my raw material. Then the other people can go to hell. Then you go about faffing around. It can also come in form of credit opinion reports. Industry, it can also enable industry research, comparing likes for likes, apple for apple, orange for orange. These are the operators within the industry. How do they fare? I know the traditional comparison is turnover. You want to compare with turnover. You want to compare with this. You want to compare with that. But rating can also be a basis for benchmarking, particularly if it comes from the same rating agency. It's also a training and education like we are doing now. As more as we report more, like I said, in the capital market environment, stockbroker appears to be the most known to almost everybody. All the same thing is happening in the banking industry. The bank is well known. If you mention to some people, we have merchant bank, they will tell you which one is merchant again. I think beside regular deposit money bank and microfinance bank, I'm not sure there are other banks that are popular. I'm not even sure half the population of Nigeria know what we call finance company. So the same thing in the capital market space. As I stockbroker, where I can easily drop my money, they help me to buy shares and I start receiving dividend. The typical Nigerian may not know that there are other agencies, other companies that are there. Okay, so rating agency provide basis for risk assessment to understand the risk. It helps to reduce information asymmetry. For instance, if we pull together in a typical insurance, maybe a bond, for instance, a corporate bond, for instance, the associated documents sometimes may not be less than 5 to 7. And perhaps each of these documents may not be less than 15 to 20 pages. So you have the trust deed on one side, you have the solicitor opinion on one side, you have the program on one side, you have share prospectus on one side, you have reporting accountant reports on one side, and so on. I can go on and on, depending on the structure and complexity of the debt that you are looking at. A typical investor, you and I, we don't have the patience to look through all of these documents and be able to pick whether there is a pitfall that needs to be avoided, whether there is a point to note, a point to ponder upon. So the information are just out there. So, but it takes a rating agency to pull all of this information together, digest them, read them, interpret them, and then represent them to members of the public in a simple alpha numeric or alphabetical represented opinion. Triple A, which everybody just know. Once you give me triple A, I am excellent. Once you give me double A, I'm very good. Once you give me A, I'm good. Once you give me triple B, I am marginal, and down that way. So even though that is discouraged, the rating opinion is not a perfect substitute for your own judgment, but someone has helped you to reduce the burden of going through all. So you can just read the 15-page, 20-page report of a rating agency representative all before you can make that opinion. So it's also lead to increased transparency because a third party that is detached from the structure is going through the structure and providing expert-based opinion. It also improved investor confidence that at least I did not invest blindly. Even though investing is taking a risk, I took a calculated risk. And it also enhanced better resource allocation of resources. Sometimes in the world of business, giving that simple maxim of the higher the risk, the higher the return, and the less the risk, the less the return. So the typical fund manager or investor could sit down and ask himself, how much trade-off am I willing to do between risk and return in order to optimize my investment? So in an attempt to do that, rating can come into play, and he can allocate his resources along the rating available by saying, okay, maybe 40%, 20% of my investment will go the way of AAA. I will put 40% in triple B. And in order to earn more money, I'll put 30% somewhere around double B, because that's a low risk. I mean, that's a high risk for high return. So it helps in making resource allocation decision. Credit ratings also play a significant role in promoting economic growth, employment, and efficient credit allocation. So when it comes to facilitating access to capital, of course, by now you now know that there are institutional investors who, by virtue of the law that set them up, by virtue of the regulation that set them up, they will not invest without seeing your credit rating. Number two, it also reduces funding costs. If you work towards getting a high rating, it might be the bargaining chip for you to be able to reduce your interest on borrowing. It can also encourage investments. It can also support infrastructure development. And we've seen it also promotes employment. For instance, rating agencies themselves employ people. And apart from employing people, they also support. For instance, if a small-scale industry is a small-scale entity is rated today, and you are rated single B or double B, one of the things you want to know, what's wrong with me? What's the difference between me and the guy that you gave single A? And I can explain, these are the issues that I have against you. This is what is wrong with you. And more often than not, for those small-scale industries that are really hell-bent on attracting funds that match the profile of their organization, are worked extensively to ensure that they can also attain that ladder of triple B, A, as the case may be. So it encourages expansion. Of course, rating work closely with debts. And once there is debts, it's hastening production, especially where such debts are channeled towards productivity. It can also lead to economic expansion. I've talked extensively on the fact that these provide efficient credit allocation. So I do not want to, overflog that. So credit rating outcomes are determined through comprehensive evaluation process by credit rating agency. So in order for a credit rating agency to make that opinion, they rely heavily on information. If those information are provided by the ratee, it is called solicited rating. If it is not, it's called unsolicited. If I have to stamp out for that information in the public space. But the information, the quantum of information that a rating agency rely upon can be broadly divided into two. You have what we call quantitative information, and you have what we call qualitative information. We have qualitative and quantitative. Now, when we say quantitative, this deals extensively with information that are relayed or represented in figures that has to be processed in order to assess financial performance, basically, debt profile, liquidity, and profitability. These are quantitative information. This can directly come from the ratee, and it can also be attested to by a third party, in most cases, the auditor. But for qualitative information, it talks about the management and the management profile, the governance, the corporate governance culture, industry and market position, the regulatory environment, the business reputation of the entity itself, and the economic conditions under which the ratee operates. This information is analyzed and subject internally by the rating agency across different levels. And the first level is that a rating model is built, which the rating analysts work with. At that level, it is represented for a review. At second level, by a line supervisor. And at that, it is also represented to committee, who now look at all of this information from start to finish and give opinion as to what the rating should be. The ratee also has an input through objection. You can be given an indicative rating of AAA and you are asking, why am I giving AAA? Then we can look at it together and say this is the rating that fairly represents your credit condition. And thereafter, we keep the same information under surveillance and monitoring. This whole exercise is also monitored by the Security and Exchange Commission as part of the framework of credit rating. So, number one, there are rules set by SEC in line with the Investment and Security Acts. Number two is code of conduct, particularly the one guiding the financial analyst in order to reduce the amount of conflict of interest that can happen between the ratee and the rating agency. For instance, rating has to be at arm's length. And a financial analyst is not expected to have up to 5% interest in the company that is to be rated by it. If you have that level of interest, you have to excuse yourself from the rating process. We also have disclosure requirement to say that you will not give opinion on an entity or instrument that you do not have information. So your friend cannot just call you and say, I have a bond I'm going to put in the market. I just need you to give me a rating report and say, okay, put my name on it, then put single A on it. No. You must have access to information. The information is what you're analyzing, whether quantitative or qualitative. And there must be ongoing surveillance. And one of the ways by which that is monitored is that the validity of every rating is published on your website. So like I said, this information that serve as the fulcrum of rating opinion is structured into two, the quantitative and the qualitative. But our focus is on the qualitative. And by this point, you already know why. And the why is because most of this qualitative information will come in parts from the entity to be rated, and we also come in parts from the public domain. And of course, you will agree with me. Once we mention public domain, we are referring to the media. This is where you are connected. So qualitative factors in credit rating is underscored by trends that have shaped credit assessment in the past regarding a rating. You could have a director who at one time has run aground a company, used the money of the company, took a loan from the bank, used the money of the company to play politics, and then the company is grounded now. And because the company has lost its reputation, the man resurfaced like 5 years later and register a company in the CSA, then come back to the capital market and want to start the process of raising funds in the capital market again. The likelihood that this information that 5 years ago or 10 years ago, I run a company, I made a mistake, the company was run aground, I took money from bank, and the bank had to write off the loan when I could not pay as a result of my participation in politics. The man at the time of interview with a rating agency may not divulge such information. But it might be when we begin to do our background checks, our due diligence, that such information may become open to us. This is where media play important role, even though you might not know that. But there are some of your past work that you have done that has aided, that has helped the cause of what a rating agency is doing, whether or not you are aware of such value that you have added. It is in the light of this that this collaboration becomes very essential, that you can keep up the good work. So we are interested in management and governance of the entity that we are rating, and qualitative information is required here. Corporate governance is about how an organization is affair, is controlled or led. And to be able to do that, we need people who are not misfits, round peg in round holes. Those with high level of integrity. These are the people that we want to be sure that they are on the board. Risk management. Do they have capacity to manage risk? Or are there risks that are obvious? There are some law and regulation that say on some companies, there must be an independent director. that is an indirect director that is not emotionally attached, so that when board decisions are to be made, I can look at the MD, I can look at the chairman in the face, because I'm not emotionally involved. I'm not involved in day-to-day running of the business. And I'm not there as a result of me being a friend of the board members. I'm only there because of my past experience, skill that I've displayed in public domain. And we feel that if we had this person to our board, then he can guide us when we are driving towards the bush paths. That's how much flavor an independent director should be. But you know, there could be instances where the MD is telling himself, why would I go and pay somebody I don't know to come and sit on the board and just be collecting director allowance? No, I'm going to bring the friend of his wife, the brother of his uncle, and so on and so forth. But these facts can be known through the media when there are reports on individuals like that. I have a question here from Ibrahim Yusuf. In your question, you say, what are the consequences of issuing a wrong or erroneous credit rating on an entity by the rater? I mean, the rater, you mean rating agency. Okay, what are the consequences of issuing a wrong or erroneous credit rating on an entity by the rating agency? The first thing you have done is that you have misled the public. You have misled the investor. That is the consequence. You have told them that someone who does not have capacity to pay his debt has that capacity, and they'll put their money there, and if eventually the money is lost, then you have ruined life of some people. And if you also connect it to the fact that in Nigeria, most pension funds find their way into the instrument issued by some of these companies and the rest. So you cannot afford to be careful, because my pension, your pension is also invested. And that's why we do not owe the ratee the duty to be careful. We owe members of the public to be careful. Yusuf, I hope you heard me well. That would be the consequence. You say, follow up to the first question. Can the entity so wrongly rated seek redress? There is no redress, except that you can prove that there is, on the part of the rating agency, there is malfeasance or nonfeasance, as we want to say. Malfeasance is when you do not act, you acted, but you do not act professionally. Nonfeasance is when you do not act professionally, if that can be proven. But because you are also involved in the process of getting your rating done, this really happened, because you cannot say your rating is wrong. Your rating opinion is based on my own benchmark, it's based on my own standard. You give me the right amount of information I'm looking at. If you are able to give me that information, then I give you opinion. It's like you presenting a woman to me and say, in my opinion, what is this woman to me? I won't tell you the woman is your wife. I will not tell you the woman is your sister. And I will not tell you the woman is your cousin. Rather than make that opinion, instantly, I'll begin to ask you questions in order to extract information for you. So my question can come in form of, is this woman living in your house? You say yes. In your apartment, which part of your apartment is this woman staying? You say, my bedroom. And say, is this woman lying on the same bed with you? You said, yes. Are there other people associated with you and this woman, like children? And you say, yes. Then with what you have said, I can tell you, in my own opinion, this woman is your wife. If you agree or disagree, as a rating agency, I will insist that the woman is your wife. That is not to say that I wrongly rate your relationship. If in the final analysis you now went to court, you now said we were not legally married, and so in the eye of the law, you are not husband and wife. If you do not contest it as at the time I told you the woman is your wife, based on information, based on the limit of information provided to me, it is not my problem, but it is yours who kept information away. So you cannot come back to allege that you were wrongly rated. Then the next question is, can politically exposed person be rated? And how can their rating affect investment? A credit rating agency don't rate individual. Credit rating for individual is done by credit bureau. Those are separate entities. The focus of credit bureau is on individual to generate their rating score. So it does not matter your status in the society. But politically exposed person as board members of an entity, if we observe that this entity, the way it is arranged, its operation has a high level of exposure to political risk, then we can begin to say, okay, how much discounts can we place on this company as a result of its political risk? So, in assessing political risk, political exposed person may be part of our consideration. I hope. Ibrahim Yusuf, please, if you had all my responses, give me a yes in the chat box area. You can unmute to respond so that I know you had me right. Okay, so I have another question from Benjamin. All right, okay, thank you. So he said, when do you draw the line between patriotism and stating the facts as it is? When do you draw the line between patriotism and stating the fact as it is? Now, your question, I do not want to pretend that I understand your question. Benjamin, you might unmute. I know I can see you. You can unmute and give me a further explanation so that I know how to appropriately provide an answer. Thank you. You have unmuted now. You can speak.
Yes. Hello. Thank you very much for your kind explanation and exposition. You know, what I want to know is that now, in terms of ratings, I know earlier you were saying that that our reports at times determine the level of rating of the rating by a rating agency. What I really want to know, how do you separate now in terms of trying to report a story? You know, you see the facts are there, very damaging report about an organization. You know, you want to do that report and you know, like you said, sometimes it affects the rating. So how do you now, okay, let me be patriotic and not write this so that it will not negatively affect the rating of this agency? So that's what I'm just trying to know from you.
All right. Thank you very much. Now it's clear, and I understand the context in which the question is being asked. As a rating agency, whatever information I got from the public domain and not directly from the rating is first line information. Is a first line information. And by dictates of our professional mind, the first thing is that you will bring that information to the attention of the organization and allow them to respond to you. As a journalist, you might not get that right of reply because a lot of time I read what you wrote, and you will say inquiry sent to the SMS to the phone of this person was not responded to. Questions posed to the MD was not replied, and as at the time of compiling this report, I got those lines a lot when I read some of these things. But for us, you cannot ignore us as a rating agency. You understand? You cannot ignore us as a rating agency because you know that if you do not respond appropriately to us and you do not give us that information that we sought, we might take it to mean that what we have seen in the public domain is correct, and we can take what we call rating action. Rating action could mean that, one, we withdraw your rating. And there are some investments that you hold that you are holding it by the grace of that rating. So we may want to withdraw or downgrade your rating. And that downgrade may bring you down from investment grade to non-investment grade. So before we go ahead to take actions like that, we will call you. We will have a meeting with you. We will present information in the public domain to you. You will respond to us. If your response is not weighty to change what we have seen in the public domain, in other words, if in our opinion, what we have read in the public domain, as a result of you not giving us appropriate response, we consider that the one in the public domain is correct and factual. Therefore, we can go ahead to take rating action, and we've done it in the past. But if you are able to provide us documentary evidence, actions you have taken in that regard, and so on, we will also take it on board. I know that it's not something. A lot of time, we also get to know that this is just a simple trade dispute happening between two parties that have gone, that agreement broke down irretrievably, and the other person was trying to use the power of the media to harass the other guy. We also say that, but that internally is interpreted. That is how professionally we handle such situation. Mr. Benjamin, I hope I answered your question now.
Yes, you have. You've done justice to it.
Thank you very much for that. All right, so we also look in corporate governance, we look at management experience. What's the pedigree of these people? How long have they been in business? We want to also get qualitative information. And sometimes you write biographies, you write autobiographies, some of the juicy details there, we can also rely and make use of them. For those of us that write economic reports or present industry reports and market reports and the likes of them, you also help us in area where, you know, we look at industry trends from your report, your market position, regulatory environment, and new laws, new regulation within a particular sector, and we can follow it as a lead to get additional information. That is the beauty of qualitative factor. Another one is economic and political factors. So from your reports, from information in public domain, we can get environmental factor, political risk issues, and economic conditions. We also look at financial reporting and transparency. Why we are holding audited accounts given to us by the ratee. Sometimes journalists, financial reporters, and the rest of them also put information in the public domain to give background stories, even as to the audited account that we are holding. And it might also be a good ground for us to also begin to engage with the entity on the quality of their reporting and the level of transparency that has been inbuilt into the audited account, that perhaps you are getting your file from a whistleblower on how they arrive at the figures, that knowing fully well that a rating agency is not an auditor. But there could be a whistleblower who choose to use the media as an avenue for blowing that whistle. You might blow whistle around tax issue, you might blow whistle around the compromise of auditor, the compromise of professional, compromise of that we are able to get that and present it and say, look, we have this information in the public domain that says that your turnover is not real, that the profit you have declared is wrong, that this person helped you to pad this. So if we have such reports in the public domain, it also enhances the process. Okay, so before I go to the media role, I know I seize the opportunity of all that the questions and my presentation to give the media role. But before I go into that, I have question here from Mr. Tunde Osho saying, against the backdrop of the CBN directive to banks and related financial institutions to increase their capital base, do rating agencies play any role in the realization of this directive and related issues like mergers and acquisition? Yes, like I said, rating is an opinion. And rating being an opinion would have been given concerning the operating entity within the banking industry prior to the announcement and even during, because the announcement came out in 2024 and the deadline is March, I think, 2026. So most of the entities that will eventually be seeking their own hands in marriage of mergers and acquisition would have had rating prior to 2024, will still have rating in 2025 until the final consummation that may happen by the end of this year or within the first quarter of next year. So what am I saying in essence? As a result of the negotiation, as a result of the due diligence, background checks, capital strengths, and the rest of them, that either party will be looking at, the rating of this entity will be one of several considerations that will be put in place by those that are advising recapitalization transactions. So that is our role, purely speaking. But as a rating agency, we are not going to play advisory role. We are not going to play an issuing role. We are not going to play a role in, we are not going to play any role in, advising those mergers and acquisition, because ethically speaking, you do not rate a transaction in which you are involved. But the independent rating that we have assigned prior to, during, and post-merger will come into play in the mind of those that are advising such transaction. Those we call financial advisors. I hope Mr. Tunde Osho gets my response. Do credit agencies work independently without being formally engaged by the ratee? And what is the timeline for a typical rating exercise? In case where entities cook the books, how do you carry out your rating under such circumstance? Mr. Yusuf, too many questions in one blow. I'll take it one after the other. Permit me. I'll break down your questions, then I will answer them one after the other. Number one, do rating agency work independently without being formally engaged by the ratee? No. Most rating agencies work on the basis of solicited rating engagements. It is called solicited credit rating engagement. Many years ago, at the early stage of credit rating exercise, it used to be a market entry strategy for credit rating institution to enter into the market, leveraging on unsolicited rating exercise, meaning I am not talking to the entity to be rated. I am just on my own. I have vested information relating to this rating agency from the public domain, and I decide to issue rating opinion. As good as that would be, it has been faulted. And one of the fault lines was that you are limited to information in the public domain. You do not have enough information to be able to carry out this rating, because not all of these rated entities have public dispositions. So your opinion cannot be as solid as the person that is involved in solicited rating. And that's why you see today that most credit rating agencies around the world, not just Nigeria, operate solely on the basis of solicited engagement. One part of your question. Then the second part of your question is, what is the timeline for a typical rating exercise? I can only share the timeline of DataPro, and today the ideal time is between a period of 3 weeks to 4 weeks for a rating exercise to take place. But don't forget that rating exercise is expand to the 1 year period that the rating lasts. That opinion is my opinion. Even though I issue it to you, I can withdraw it at any point in time. And because I have that responsibility to withdraw or maintain that rating, I also have responsibility to continue to monitor you as the ratee, your capacity to continue to carry such a rating. So in assigning the rating opinion is a period of 3 weeks to 4 weeks, but to ensure validity, start from the day the rating starts and it only ends when the rating expires or the rating contract ends. The last part of your question is this. In cases where entities cook, I want to believe that the word cook there means falsified the accounts. How do you carry out your rating under such circumstances? The essence of rating is not to audit. So a rating agency is not an auditor. But one of the mitigants that we put in place to ensure that the accounts you are giving us is not falsified is that we place less weight on accounts provided by you, and we place more weights on audited account. Account provided by the organization, we refer to it as management accounts. Less weight is placed on it until it is audited. More weight is placed on audited account because we believe an independent party to your organization has stepped in to look at your books and has given a vote of confidence in that document before we begin to use it. Some entities are regulated, especially banks, insurance, microfinance, and the rest of them. Before their document even get to us, they even have responsibility to submit to their regulator, and their regulator has approved that it is okay before they even give to us. That's the first part. What's the second layer? The second layer is that those who are going to be the first level of review, who are going to carry out the first level of review on those accounts within our organization are also trained accountants and finance experts who, to a reasonable extent, and I use that word, reasonable, with all caution, who to a reasonable extent are also trained to spot whether this document is accurately complied or there are issues that require further engagement and follow-up with the rating or the rated entity. So I think those are the three questions I could glean from what you asked, and I hope I answer your question. But you have quickly added another. Say follow-up question to the first one. Is it legal for a third party to request a credit rating of an entity, e.g. a company A requesting credit for company B? It is not illegal. It depends on the relationship between the company that is requesting for the rating and the company that is to be rated. Sometimes you can have a private equity investor who want to put money in your company, and in the course of doing that, discover that you have never secured a rating. He might ask you to submit yourself to a rating and then make payment for the exercise. So it is not illegal for a company to request for the rating of another company, as long as there is a relationship between the two of them. Okay. So how can a rating agency separate itself from an organization it has an interest in? That can be done at arm's length. We can also do that through a disclosure. I also mentioned that the rule of engagement is that the first point of the separation is that a financial analyst that is going to work on that company will not have interest of up to 5%. So what it then means is that if I, as Dele Adeoye, am having 5% shares in maybe First Bank, for instance, when we are going to carry out rating of First Bank, Dele Adeoye is not expected to be involved in that process, or it's not expected to be a director and so on. So in that way, we have reduced the level of conflict of interest that would be involved in such. So Ibrahim, I hope I answer your question again. Thank you for keeping up the fire. So on a final note, I think even though I've mentioned it in various ways, I just want to end by saying that the role of the media generically in helping to shape qualitative data or qualitative information that is necessary for rating is such that objectivity is key. We will love a situation whereby you report objectively. You know, one of the questions I've had to attend to in the course of this presentation is issue of patriotism. And we expect that the media too should be patriotic. Even if you don't know before, you now know that some of your reports have what we call far-reaching implication. And so when we are reporting, we expect that as much as possible, ensure that you report objectively. I've come to understand that in Nigeria, when we want to deceive ourselves, we speak big English. So let me break it down. The meaning of objectivity here is just that you report facts, because someone is going to be relying on those facts to make certain decisions that will have bigger implications. We expect that media will also help in conducting market research and so on. You know, a lot of time when you do your market research and you say the biggest player in the market is this company. Next to that, next to that, next to that. Or you write reports that suggest to us like that come like this. Top 10 company in automobile sector. What you are doing is that you are giving information that will be further processed by someone somewhere. That can also enhance what we do. Independence, reporting objectively, independence of the fact you are not influenced by any factor. Surveillance, helping to monitor the activity within a sector. Business analysis, and I think I've read a couple of analyses that are top-notch in the time past. Doing reasons behind the figure, providing expose, and the part I love so much is investigative journalism. With that, before I conclude, I think a question dropped here for me from Mr. Festus. In assisting the media to have a better grasp of the industry where you operate, is it in your immediate official plan to fund the training of journalists covering your activity, for instance, at the Lagos Business School? This could be part of your corporate social responsibility. Well, we will take this as a suggestion from Mr. Festus. It's something that we can look at. I know in the present we've had a relationship with Lagos Business School, but this is on a different note. This is on data protection and data privacy issue. But why not? We can also add credit rating to the pack. So thank you very much for bringing up that as a suggestion. Mr. Tunde, you say, I hope we or I can get or have the full transcription of Mr. Dewe's delivery, especially this is powerful conclusion. Of course, thank you very much. The slide will be made available to every participant. And I think beyond this, we will also be doing some giveaway to those of us that help in helping to give maximum publicity to the outcome of this presentation. So we say that the media has the unique advantage of assessing the qualitative data. You have that unique advantage of doing that. You know, you meet a lot of people on social platforms. The difference between you and us is that why it is possible for you to meet people on social platform, we meet people on official platform. And so sometimes information could be packaged or structured. I'll break down what I mean. When you go on the street and you meet a policeman and the policeman is saying, yes, Mr. Man, who are you? Then you have to adjust your gaze, adjust your composition in responding to those questions because you are talking to a man of the law. But when you meet the same policeman who is now not wearing uniform in a party, and you say, how can I meet you? You are very free to say, oh, I work here and there. And then the man introduces himself, and that with that, you get a lot of information. You bonded so easily. But when this policeman is in uniform, there is limit to information that you get. And that is the same thing with us. As rating agency, we get and extract our information on official setting. But you get your own information on a social level. And there is opportunity to get more qualitative information using social avenue than to use official quota. And so we conclude that you are at unique advantage of accessing qualitative data. And you can therefore assist the larger credit economy through objective reporting. And it is on this note that I want to say thank you for coming. It's been a wonderful time to have you. I guess I answer all the questions from the chat box, and I think there is no more for me to respond to And I want to say again, thank you. It's nice to have you around. God bless you.
God bless you too.
Thank you, Mr. Benjamin. All right. So
Thank you.
Thank you, Sunday Ojeme. Victoria, do we have closing remark from you or from Kenny?
Thank you too.
Thank you, Mr. Tunde Osho.
Thank you for the powerful presentation, Mr. Dili. And to everyone, we will send you the recording and presentation slides. We'll send them to your email. Thank you for coming, and please enjoy the rest of your day.
Yes. And you too.
Thank you. Thank you.
Thank you.
Bye, everyone.
Bye.